the U.S. government has decided, in their wisdom, by the way, whether or not you agree with U.S. policy, to export U.S. policy to other countries who may have their own agendas. The weaponization of the SWIFT banking system, which is not U.S. property, but the U.S. government has decided to do anyway as a consequence of the fact that it's denominated in U.S. dollars. And further, the theft by the U.S. government of $300 billion worth of Russian holdings of U.S. treasuries. Again, whether or not you agree with Russia's policy or America's reasons to do so, has caused governments around the world who believe that they might come into the sights of the U.S. government. As an example, the Russians, the Chinese, the Indians, the Saudis, to question their holdings of U.S. Treasury securities and their use of the U.S. dollar for international trade. A second problem, I think, is that the arithmetic around U.S. Treasuries has gotten worse and worse and worse. We came through a period really of U.S. dollar hegemony. I would suggest in the period 1982 to 2022, the internationalization of the U.S. dollar and the decline in both nominal and real interest rates were tailwinds for gold. Now, I think that foreign countries in particular that look at the U.S. dollar and look at U.S. treasuries see an instrument which pays them 4.3, 4.5%, I'm talking about the U.S. 10-year, in a currency where, separate and apart from the CPI, they see the purchasing power of the currency decline by 7 or 8% compounded. And so they're stuck with this sort of a conundrum. You invest in an instrument which gives you a negative real rate of return, and you do so while exposing yourself to the risk of the extraterritoriality of U.S. policy. It's a real lousy bargain for those countries.
Countries around the world are making moves that could lead to the collapse of the U.S. economy. The U.S. government's weaponization of the SWIFT banking system and the seizure of $300 billion in Russian holdings have caused global alarm. Nations like China, India, and Saudi Arabia are rethinking their reliance on the US dollar. For instance, China has slashed its US Treasury holdings by a staggering 70% in the past 6 years. These countries are now turning to gold and local currencies, moving away from the dollar. Meanwhile, the purchasing power of the US dollar is plummeting, with real inflation rates impacting everyday goods and services far more than official figures suggest. The arithmetic around US Treasuries has become increasingly dire, and foreign holdings of gold are skyrocketing. If this trend continues, the dominance of the US dollar could be at serious risk. The implications are enormous, and they could affect your financial future in ways you haven't imagined.
It can't be any surprise that the Chinese, as an example, have reduced their holdings of U.S. Treasuries by about 70%, over the last 5 or 6 years. In the first instance, they think that investing in their own economy and in their Belt and Road strategy around the world yields higher real rates of return than they would if they were invested in U.S. Treasury securities. And they also allow themselves to escape, at least in some sense, the extraterritorial imposition of U.S. policy through the U.S. dollar. So it's no particular mystery as to why foreign holdings of gold have increased and foreign holdings of U.S. Treasuries have decreased. If my memory serves me correctly, their holdings were 3.3, 3.4 T, and now they're under 1 T. It would appear that the only major country whose treasuries are effectively unchanged has been Japan. And I think for Japan, the reasons for that are twofold, but one of which probably involves their continued efforts to keep the yen cheap relative to the dollar so that they can continue to export items from Japan to the United States, which is to say, in effect, it's an employment strategy or a domestic political strategy for Japan. Well, that isn't necessarily true in other countries. Gold is an instrument that reacts to fear. And we've lived through 40 pretty benign years. going back to the beginning of the lowering of the U.S. interest rate in 1992, all the way through 2022. Stock market was up, the bond market was up, there was lots of liquidity. I'm not trying to say there weren't some punctuations, 1987, 2008. We had some pretty dramatic punctuations, but the lessons that we learned as investors in those punctuations were that you'd buy the dips. The truth is that people were pretty optimistic because financial markets were continuing to do well. This reminds me a bit, frankly, of the late 60s and early 70s, when all of the indications of inflation were in the system, but people hadn't experienced it yet. They'd lived through 2 benign decades after the end of World War II. And while people read about inflation, it wasn't until they had sort of 5 years of experience with inflation. It wasn't until they'd seen the price of gas at the pump go from 20 cents a gallon to $1 a gallon, as an example, that they began to internalize the lessons. And I believe that the same process is underway right now. We talk about inflation, we feel inflation, we think about inflation's impact on others, but we've been schooled through 40 years of pretty benign economic climate to be aggressive, not cautious. Now, my belief is that after 3 years or 4 years or 5 years, people will begin to understand the price that they pay for the diminishment of the purchasing power of the dollars that they earn working or in their savings. I suspect that you'll look at the CPI, which suggests that, quote, inflation is moderate at 2.6%. But you'll look at what happens to the basket of goods and services that you purchase that impacts your lifestyle. And you'll say, wait a minute. The purchasing power of my dollars isn't decreasing by 2%. It's decreasing by 7% or 8%. And if you experience that over 5 years, if you watch your rent, as an example, if you were a renter, increase by 6 or 7% compounded. If you watch the cost of a shopping basket full of groceries increase by 100% over 4 years, all of a sudden you come to the same conclusion that retail investors came to in 1972 and 1973, which is to say all is not well. And I think it's that consciousness that really kicks off a market in the metal. And let's talk about one other thing while we're at it, which is to say the probability of increases in the future. I don't want to give you a Canadian number because I don't know it. But in the U.S., the on-balance sheet liabilities of our government exceed $34 trillion. The off-balance sheet liabilities, though, Medicare, Medicaid, Social Security Trust Fund, military pensions, government pensions, all that kind of stuff, exceed, according to the Congressional Budget Office, $100 trillion. And we propose to meet these obligations with a budget that goes further into deficit by $1 trillion every 100 days. Now, how do we get ourselves out of this conundrum? Understanding that America's GDP is under $30 trillion, which is to say our GDP is less than our on-balance sheet liabilities and is 20% of a combination of our on-balance sheet and off-balance sheet liabilities. How do we solve this? Well, they say, tax the rich. Top 1% of Americans have an aggregate net worth of $5.8 trillion. If you stole the entire net worth of the 1% in the United States, you wouldn't have solved the debt. What you would have done is funded, something like 20 months of the deficit. So you got to throw that one out. Well, how about tax everybody else then? Good luck with that. How about curtailing benefits? Let's say to the old guys like me, hey, Rick, you voted yourself a whole bunch of cool benefits for 40 years. You forgot to pay for them. We're not going to give you the money. You follow me? There's a whole bunch of hard choices. And you know what? We faced those hard choices before. Not as hard, but we faced them in the decade of the 70s. We had unsustainably high debts. We couldn't raise taxes. So what did we do? We inflated away the real value of the obligations. The purchasing power of the US dollar over the decade of the 70s declined by 80%. So we didn't renounce the debt in the honest, old-fashioned way by saying, yeah, we owe, but we ain't going to pay. Too bad, too sad. What we did is we made the debt less important relative to the inflated dollars that we took in via taxation. So my suspicion is that the way that we deal with this $130 trillion obligation or series of obligations is that we, in effect, inflate away most of the present value of the obligation. There needs to be some money left over for people to live on. There needs to be a little money left over to reinvest to make sure that the sustaining capital in the private sector continues to be strong enough that at least they can continue to tax. Meanwhile, in the United States, before local expenditure and before debt service, government currently consumes almost 40% of GDP. So how much can you raise tax? Particularly, how much can you raise tax relevant to the size of the obligation? Let's say, just for fun, and I don't think it'll happen, that you got around to balancing the US budget, which is to say you didn't increase the deficit anymore. How do you deal with the $34 trillion that you owe the bondholders? How do you deal with the $100 trillion that you owed folks like me for Medicare, Medicaid, and Social Security? Even if we found $3.5 trillion via increased taxation, we've shown arithmetically that can't come from the billionaires because they don't have it. How do you deal with the debt?